Are you ready to unlock the secrets of building wealth in your 20s and 30s? Discover actionable strategies, savvy investments, and set you up for financial freedom for the rest of your life. Tune in now and let's kickstart this into a prosperous future. When it comes to building wealth in your 20s and 30s, this is probably one of the most difficult times because you're just getting established in your career, just starting your first job. However, this is the most financially fundamental point of starting off for the rest of your life because you do have the ability to build compounding interest and also start getting the most advantages that we see within accounts. Number one, we look at the tax advantages of a 401k plan or an IRA plan. Starting again in your 20s and 30s, if your employer offers a 401k plan, your goal is to get it up to that 15% and start it right away. Contributions are tax deductible when you set up the 401k, but ultimately, personally, I would look at doing the Roth option if there is a Roth option for the 401k, if there is a Roth option for the IRAs, because you're actually going to allow that money to grow tax-free, which can be huge when you're a younger individual, again, 20s and 30s, and a lower income earner. Getting the offset of the tax advantage doesn't have quite the benefit that you're going to see when you're in a much higher tax bracket, allowing, again, the money in the savings account, in those investment accounts, to actually grow tax-free. Now, you don't want to miss out because, like I said before, guys, this is one of the biggest things when it comes to the compounding interest. If you start putting away 15% when you're 18, 19, 20, start getting into the career, let's say get to 25, then you're looking at 30. Putting away 15% every single year is going to really allow you to live off of the take-home income, which means it is not going to be the gross income, it is going to be the net income that you're actually taking home from your paycheck. As you get raises in the future, you are going to lock in and you are going to keep that 15% consistent through your entire career. And I guarantee you guys, you will invest within an absolute absorbent amount of money in your investment accounts if you stick to that 15%. Second one, building the emergency fund. This fundamentally is the very first thing that you have to do when you're starting to build up finances. Getting $1,000 put away in that emergency fund, that is going to allow you for unexpected expenses to go ahead and cover those without borrowing. I cannot stress this enough, guys. We have seen we are over $1 trillion right now currently in credit card debt as a nation. By putting money aside on a regular, consistent basis, it builds not only the habit, but it builds the discipline of saving. That is one thing that I think fundamentally we are missing, is not having that savings account. Also, having extra money will help you avoid landing in an unexpected expense. If something should happen where we see a lot of people that want to buy a house, borrow against the 401k, have an emergency, borrow against the 401k, cash out investments. That is not the thing we want to do, guys. Putting that 15% in there, you want to make sure that 15% is going to stay in there. Number three, make a basic budget. The younger you do this and the more often you do this, the more beneficial that you are going to see. Set a savings goal for yourself and make sure you're paying yourself first. If you're putting away $5, $10, $50, $100 a month, you want to make sure that you're paying yourself first and you're putting your goals first, your financial goals. It is not, hey, I spend all my money, I get my paycheck, I spend all my money at the end of the month. How much money do I have left? You can be one of the people that, hey, I pay all my bills. I have this much money left at the end of the month. What am I going to do with it? Where are we going to put it? Is it going to debt? Is it going to savings? Is it going to repayment? Is it going to savings, investing, whatever it may be, guys? It is fundamentally a different way to be taught when it comes to cash flow management. A lot of people do the 50-30-20 rule. I do zero-based budgeting. You can look at that. I have a video out there. I believe it is in the budgeting section for the zero-based budget. That is how I do it. But make sure that you're doing it at least on a monthly basis to see the seasonal budget and also the things that do change when it comes to your budgeting strategy. Number four, managing the debit and the credit. This is one of the big things, guys. If you ever follow Dave Ramsey's advice, he always says use a debit card for everything, never use a credit card. This might have worked 10, 20, 30 years ago. Building a credit history at the ages, again, from 20 to 30 is fundamentally going to make everything cheaper for the rest of your life. If you have A+ credit, maintain A+ credit, maintain a strong credit history. Accounts are paid off in full. When you go to finance a car, when you go to finance a home, when you go to get a loan, you are going to be guaranteed approved because of the strong pay history and also not carrying debt, guys. This is one of the things that fundamentally people get in such a hole where you're paying an absorbent amount of interest on credit cards that literally you get to a point where you can't dig yourself out. Bankruptcy, then you're looking at collections, you're looking at a lot of things that are going to affect your credit, and this is going to drop it substantially. Now, when you get into your 30s, it's a little bit of a different structure, guys. Reassess the budget that you have and also get ready for major life changes. You can see see this in the 20s, you could see this in the 30s. What we mean by major life changes is when you're getting married, when you're buying a house, when you're starting to have kids. These are big expenses that, again, are going to kind of rattle your budget. You're going to have to reallocate some, but remember, we are keeping that 15% investment intact. That is where you want to go. That is the goal that you want to get to. When you look at other expenses, really, again, reevaluating that budget on a monthly basis. That way you can start saving more money as you increase and as you get more salary, as you're, getting promotions, moving to other jobs, things of that nature, making sure you have the money to cover those expenses. Final one, guys, continuing saving for the future. This is one of the big ones. Continue contributing to the 401k, IRAs, use and raise and build your savings. I cannot stress this enough. We're at a point right now where a lot of financial institutions, including investment accounts, will pay you for the money you have. So think of it, you're kind of on the flip side of the equation where at one time, you're buying a house, you're paying X amount of interest. You buy a car, X amount of interest. You have credit card debt, X amount of interest. All of the money that is going to interest, you have to financial fundamentally get on the flip side of that. And what I mean is getting to the point where banks are paying you to have your money. So right now, CD rate, savings rates are around 5%, which can be a 5% return to you every single month on some cases, every single quarter, every single year, getting a good return on investments, getting a strong return on the finances that you have in there. If an emergency happens, if you have an unexpected expense, if you have money in the bank, doesn't make a difference, guys, because you already have the money to really cover those expenses. Protecting your wealth. This is something that a lot of people really overlook. There can be a lot of unexpected things that happen in life. This is why a lot of people do look at term life insurance. You can lock in rates for term life insurance 20 years, 30 years, 40 years, possibly even more, guys. God forbid that something happens to you as the breadwinner, as the individual that has, the highest paying job. You want to make sure protecting your wealth, protecting your family. Fundamentally, you don't want to leave them in a very, very bad situation. And it's something, of course, a lot of people do not plan for, but you always do have to plan if something should happen when it comes to a job loss, when it comes to childcare, when it comes to child education. The more that you're saving and the less that you're financing, the less debt that you are accumulating is going to make a big difference to really building that wealth when you're 20s and 30s. So all right, guys, so that'll do it for today's video. Let me know in the comments what you guys think about building wealth in your 20s and 30s. And as always, thank you guys for watching.